to another exciting episode of Investors Playbook Live. As always, you have your co-host Deshaun and Cornell. And today we're coming at you with some tax strategies. All right. We don't talk a lot about taxes on this podcast, on this show. But it's February 2026. Means you have 2 months to figure out what you're doing with your taxes and submit them. We all know April 15th is that deadline to get your taxes done unless you file for an extension. And if you have a business, you have even less time. You have till March 15th, meaning you have 1 month. So, wanting to make sure that those dates are understood, remember you can file for an extension, but they might still come for you if you have some taxes that you have to pay, right? They want you to pay them before that date even comes up. So, figuring that out is important. But what we're talking about today is some of those strategies that come with owning stocks, owning shares of a company, and how purchasing stocks matter very much so. But selling them, when to sell them, and choosing which stocks to shares, which we'll get into, matters even more. So Cornell, let's just dive into it. The definition for today is going to be tax lots. All right. If you haven't heard of it, my man Cornell is going to explain it to you in depth. So take a listen, man. Go ahead, Cornell. What exactly is a tax lot?
So I just wanted to go back to like how I even figured out about this. So recently I started getting into leveraging low interest loans in order to invest in the stock market, especially like in large downturns. I'll pick up reputable companies at that time. So of course we just had a big downturn about a week ago or 2 weeks ago. So I've been trying to figure out, okay, how can I position myself in a way where I can get uh, as much of these reputable companies as possible. So what I did is I went into margin, right? So I took a certain amount of money from margin and I bought a batch of shares. And I was thinking, like, man, I've been in Microsoft all this time. So what I don't want to happen is for me to purchase more shares of Microsoft. And then when I sell Microsoft, it's selling those previous shares where I already have big gains in,
Mm,
which will give me a large tax liability. So what I did is I Googled it and I found out about tax lots, right? And tax lots are individual batches of shares that were bought at a specific date or time. So
mhm.
now I know that I can take this borrowed money, the shares that I purchased, I can sell those exact same shares and then just take the gains from that. And it won't mess with the shares that I've already bought with my own money. The shares that I've accumulated with my own money.
Interesting. So if I could ask a question just for clarity, you buy Microsoft shares, say 2022, right?
Mhm.
You buy 50 shares for a specific price. That's a tax lot, essentially.
Right.
You purchase another batch of Microsoft shares in 2023, you buy 25 shares. The price is higher. Now you have 75 shares of Microsoft. So it shows one price like on Fidelity. But if you dive into the tax line, you can see the separation 50 shares in 2022, 25 shares in 2023. And you can literally choose to sell five of the shares that you bought in 2022, 2023, rather than touch the ones from 2022.
Mhm.
That's and that's crazy, man. I I'm trying to just imagine like how powerful that can be when it comes to tax strategy, right? Because when you're thinking about short-term capital gains, meaning you have to hold something over a year, if you want to avoid that, but you want to sell some shares of Microsoft, you would want to sell the shares from the previous year that have been in your possession for over a year. But also to your point, if you don't want to experience those large gains, right, then you would sell the ones that you bought more recent. So
This is good.
yeah, that's why it's always important to get your tax advisor, your tax strategist to help you through this process because the the opportunity is there, but it's
Yeah.
best to know how to navigate it. You know what I mean?
And I can see
Mhm.
like there being a lot of situations where this is necessary, especially like if you're trying to say you're trying to make a large purchase, right?
Yeah.
And you want to sell some shares in order to make this purchase, like you're buying a house or whatever, right? When you're selling shares, you want to sell the shares that have made the least amount of gain, so that you'll have a lesser tax liability. So it
Mhm.
doesn't have to just be if you're buying a lot on with debt or something like that. It could just be, hey, you want to sell some shares to buy a different asset, or you want to sell some shares to go on vacation if you're to that point. But
Yeah,
whatever it is, it's an important thing to know about, and it's something that you should consider.
definitely. Especially when you start combining tax strategies. Like, say, for example, you are leveraging a traditional IRA, and before the year is over, you want to take that money out. Or, say you've been building out your retirement account for years. Every paycheck, for the most part, you're buying new shares, right? Every single time you get a paycheck, your company matches, you're purchasing more shares. And I'm wondering if those are just going to be multiple tax lots, right? Is it, I'm wondering, is it through the year or is it just like that specific date? So every 2 weeks, you're going to have a different tax lot given when you purchased it. And same thing with dollar cost averaging, right?
Anytime you buy, it's a different
Anytime
tax
you
lot.
buy, it's a
Like
different tax lot.
if you have Fidelity and you look at a specific investment and you just
Hmm.
scroll down, it'll tell you every transaction that you had. Those are your tax lots. So if you
Interesting.
if you bought February 10th, you bought 100 shares, and then you bought, even if you bought later that day,
Yeah,
you bought another 100 shares. Those are going to be two different tax lots,
different
because it's
tax.
not just the day, it's the time also.
Interesting. Yeah. You can get real strategic with some of the like all the different tax strategies that surround the stock market. But no, I think that this is definitely something that people, once they know more about it and can understand it, can really use this to their advantage when figuring out their taxes, right? That's why we talked about the difference between getting your tax prepared and then tax planning. Planning is done the year of uh, the year that you are going to prepare and submit your taxes. I don't know if that made sense, but for example, you plan in 2025 to do your taxes and you prepare in 2026 to submit your 2025 taxes that you've already planned. So, just hoping that that makes sense. Um, but yeah, I think that tax lots are super interesting. Something else that we wanted to talk about is your cost basis. That's also a very a less known vocabulary word that gets used in the stock market world a lot. But what exactly is your cost basis, and how does that factor into um, taxes? Your basically your starting point. Like what is your cost basis?
Yeah. So your cost basis is what you paid for your investment, right?
Mhm.
So say Microsoft was $100 when you bought it, right? But now Microsoft is 250, right? Your cost basis is $100. That's how much you put in, even
Mhm.
though the value now is 250. So this is also how you know how much you gained or lost. So if your cost basis is $100 and the current price is 250, that means you have $150 gain, right?
Mhm. Mhm. I
Per
see.
share that you have.
Got
So
you.
with this, one thing with this, it's really easy with stocks, because if you transfer stocks, you just fill out the form, and then the broker just kind of communicate with each other. But there was this one occurrence when it came to crypto, right? Where I
Mhm.
bought Bitcoin. I've been buying Bitcoin on Robinhood for a period of time, where it was kind of like uh, every 2 weeks I would make a transaction. This is something that I was not thinking about, right? Because of course Robinhood had my cost basis on there. But when I transferred my Bitcoin from Robinhood to Fidelity, Fidelity didn't know my cost basis. So I got a red exclamation point that said, enter your cost basis, right? And the thing is, you want to do this because if I didn't put in a cost basis, they would have counted all of my Bitcoin as profit.
Mm-mm.
So if I had $100,000 of Bitcoin, even if 50,000 of that was my money, $100,000 would have been gains, and I would have had to pay taxes on all 100,000. So it's
Yeah.
it. So when it comes to that, I was doing a lot of research, and I was trying because at first I didn't really know how to calculate it. So I was like, okay, so what if I don't know my cost basis? It was saying that the IRS says that you have to make the best attempt possible to figure it out. So I'm so glad that this happened at a time where AI is a thing
Hmm.
and it makes it a lot easier to do calculations and things that I would not have been able to do on my own. So, yeah.
Yeah.
Um,
Nah, that I think that even just having that lesson happen, like you said, at the right time. Because, yes, the time to, I guess in this case, you would have had until 2027 to figure out the taxes. But still, the fact that they are like saying, figure this out now so that when the time does come, we don't want to, well, not, they're not saying that we don't want to, but they're like, if you don't, then we are going to tax all of this at this point because we all see it as gain. We only see it as gains. And I guess in most cases, the brokerage, like you said, does keep track of your cost basis.
yeah.
So, yeah, for the most part, your cost basis is not something that you necessarily need to calculate. Um, but do other things also factor into your cost basis? Like if you were to purchase a mutual fund or ETF that has fees associated with it, is that included in your cost basis? Or is it just how much you pay? You know what I mean?
I'm pretty sure it's factored in some type of way because they take the fees out of your investment.
That's true. That's true.
So
Yeah.
it'll probably factor into the gains and
Hmm.
not exactly what you put into it. That's just my guess.
Yeah.
I'm not 100% sure, but I don't see how it wouldn't factor in.
Got you. No, that's right. Cool. And something else that I wanted to circle back on when it comes to tax lots, a lot of majority of the brokerages are going to default to something called FIFO, which is first in, first out. That's essentially meaning the stock that you bought first. Doesn't matter how many stocks you bought after that. When you sell, they're going to sell the first stock you bought, unless you change your tax lot strategy or position. The opposite of that is last in, first out, which is essentially doing the opposite. The last stock that you purchase is going to be the first one that gets sold once you hit that sell button. So they have FIFO and then they have LIFO or LIFO and FIFO. But by default, most of them are going to be first in, first out, meaning unless you declare which um, which specific tax lot you are wanting to sell, you're more than likely going to sell your oldest share. Just keep that in mind as well. So you're probably going to sell the share that has the most gains, which means you'll have to figure out how, the taxes that are going to come with that large amount. So as you are preparing to strategize, and you are talking to your tax advisor, your tax strategist, just keep those two things in mind, right? Tax lots, your cost basis, because they can definitely affect your specific year, not even just the year, but the years to come, right? People plan taxes out well in advance before 2026, 2027. They plan for 2028 in 2026 because you can roll over a lot of these things. So definitely something to keep in mind, something to consider. But again, the vocabulary words today: tax lots, essentially a forever ledger of every stock that you purchase, right? Letting you know the time, the date, the cost, and you can choose which stock you want to sell if you have multiple that are bought throughout the year. And the cost basis, of course, is just how much you spent to purchase the stock, and that can be calculated by easily saying your capital gains is going to be equal to, or the cost basis is going to be uh, the the capital gains. That's the gains that you make minus the sale price. Or did I say that right?
Yeah,
Okay.
basically.
Yeah. Sell
Yeah.
price minus capital gains is gonna how much you paid when you bought the stock. That's your
Yeah.
cost basis. Yeah.
Mhm.
So yeah. So just some quick tax plays for the folks that are tuning in.
Yeah.
Um,
And of course, this is for people that have already been getting into the stock market. They pretty much know what they're doing. So I know that
mhm.
this topic is going to be more advanced, but if you want to really understand. stocks and how to best maneuver it efficiently. This is really all information that you will want to know.
Hmm.
And yeah, I love that there's still things that I'm learning every day, and I hope that y'all are doing the same. So
Yeah.
yeah,
Yeah.
it's important.
People are using tax lots in very unique ways too. I wanted to add, you've heard of something called tax loss harvesting? So, for example, you buy Microsoft in 2022, you buy Microsoft in 2024, but that 2024 Microsoft tax lot is down. People will take those losses, sell that specific tax lot, sell those losses, I mean, capture those losses to offset some of the gains. So there's a lot of strategies that go beyond short-term and long-term capital gains if you're talking about specific tax lots, especially if you want to like offset some of your gains, or again if you want to leverage long-term um, long-term capital gains or long-term gains instead of getting hit with that full short-term capital gains costs, because long-term capital gains are taxed at a lower tax rate. So yeah, like Cornell said, it is a bit of an advanced strategy, um, but that is the purpose of this show, right? To get people to that level to where understanding and utilizing and using tax lots as a strategy can benefit them on their journey to be more financially independent and financially free. So, yeah, we hope that some of the information in this episode gave you some knowledge, maybe gave you some things to think about, to talk to your tax advisor about. But yeah, I think that wraps it up for today, Cornell.
Yep. So we appreciate everybody that came on to
Absolutely.
support, and we will
Absolutely.
see you all next time.
All right. Peace out. Catch
All
you
right,
next
y'all.
week.
Peace.